presentation, which we love to see. I'm going to hand it over to you, Nick, and let you introduce UGE to SED.
Yeah, sounds good. Yeah, thanks so much, Paul. Thanks so much, Trevor. And yeah, happy to have the opportunity to update everyone on this. So now, number one is the presentation that I'm sharing right now is a slimmed down version of the one that you can find on our website, just to keep it high level for these purposes. So anyone who wants a little bit more meat, you can find it there. Like you were just saying, so in terms of the share metrics just off the top, been trading about 37 to 40 cents recently, market cap just under 10 million Canadian, fully diluted about 29 million shares outstanding. Insiders, we own over 50% of the company, so we're very vested in making this a success. And yeah, and in terms of like revenue size, right now we report in US dollars, but our trailing run rate is about 3.6 million US, and a big part of our story, and I'll go into this in more detail a little bit later, is the backlog as of March 31st was 72 million US, and we've announced a few additional contracts since then as well. Our Q2s will be out on Tuesday of next week, so I'll of course be careful what I say, but also we'll update that backlog number as part of our Q2s as we always do, and so look forward to doing that next week. And I guess I'd be remiss not to give a little plug. You can sign up for our webinar on UGEI.com/register. So briefly in terms of what we do, so we're a commercial solar company, and we have like a real end-to-end platform in this space. So that's really, first and foremost, the way that we differentiate ourselves versus our competition is that we originate our own deals, we engineer and build them, and then we finance them to own and operate them. So that's what we do. That's all we do. I'll mention off the top that if you've known the company for a little while, we've always been a commercial solar company, but over the last pretty much exactly 2 years, we were also doing like the services aspect of this business, in essence, like building projects for other developers, and we downsized that business in a bit of a turnaround starting in mid-2018. And we'll go into more of why, but we really just focused on like, the core of the business and what we want to do, and that's this end-to-end platform. And that's what we really differentiate ourselves against the competition with, and we'll go into more detail a little bit later in terms of how that plays out. I know the overall ESG theme has been a lot more common of late. So just briefly in terms of the overall solar market, number one is that from the time that clean tech was really hot, from 10 to 12 years ago to now, the industry has just changed dramatically. The first time we purchased solar panels were close to $4 per watt. Right now, depending on the market we're in, it's 20 or 30 cents a watt. So close to 1/20th of what it was at the beginning. And that's just made solar a huge and growing force in the US and around the world. The metric here, though, is that 40% of all new energy in the US last year was solar. That, of course, is within an administration that doesn't really like solar that much. So really speaks just to the economics of the technology and where things are going. So we're in the commercial solar space. Commercial solar's grown 8x in those last 10 years, but it's still the smallest out of the main subsets of the industry at less than 1% market penetration. But it's really starting to pick up. And the New York market, this is, by the way, like our dual headquarters is in New York and Toronto, but the New York market is one that we're very active in and see really big potential for. So far, there's been about $30 or $40 million worth of projects in the New York City market of the commercial and community solar type of projects that we do. We estimate there'll be 1.2 billion worth of projects is our management forecast this decade, and we're top 2 player in this space right now. So we see a lot of upside, not just in New York, but just using that as a straw man to talk about how we see this industry growing. And of course, it's all because solar is very economical now and cheaper than the grid in more and more places. So in terms of UGE and the opportunity here, number one, very, very focused. I talked about this before, but we had probably tried to be too many things to too many people in the period of time of 3, 4, 5 years ago. We really slimmed things down over the last couple of years. It was a bit of a painful process, as anybody who's gone through a turnaround would know, but we really feel good how we've come out the other side. So really kind of throughout 2020, we've been just very, very focused on, you know, the past unprofitable business that we spun off is behind us, or we wound down is behind us, and just very focused on developing our own deals, develop, build, own and operate our own projects, and that's been going really well for us. The backlog growth has probably been the most talked about aspect of our story this year. So we had started the year with about 30 million in backlog, which by itself we thought was very large. We had a goal to grow at above 50 million, but we actually grew at over 70 in Q1. And we've announced additional deals since then. So like I said, we'll update that number here soon. But it's growing so quickly in part based on, I think, this focus and not having the distractions that we had in the past, the overall economics and market for what we do, and yeah. The sector, of course, the sector is attracting more attention. We're happy for that. I think that the time has come for an industry that now is, stands on its own 2 feet and provides really good economics. The company itself, so we're valued at somewhere in the range of 1/10 of our backlog right now, and I think there's a good value play there. And then also like a very clean market presence. So that turnaround I mentioned was challenging, but insiders really supported the company and other key shareholders as well to ride that out, and we feel a lot better for it, and so we think we could do a lot of good things going forward here as well. So the one word on the sector that we're in here in particular is, this isn't your hippie uncle's solar industry. Like this is, instead it's a matter of like, what we do is we work with real estate owners, and for those real estate owners, we find regions where the economics are very good. We go to those businesses and we pitch them on typically one of 2 things. So on the one hand, we'll lease the rooftop off of you, and pay you an annual lease payment for typically 25 years, and then we'll sell the energy kind of into the grid through community solar mechanisms that we work with. In some cases, the building owner wants to use the energy themselves, and they can buy it at a discount to the grid, or some combination of those 2 things. So that's how it's working. One main aspect of our secret sauce is identifying these good opportunities, these good regions where the economics are very good, and being able to put together these deals, and find good real estate clients that we can work with time and time again. But for those real estate clients, what it means is, they don't pay anything up front. They benefit as soon as we build the system, and there's no hassle to it. So UGE is owning 100% of the project lifecycle. And again, I mentioned this, the turnkey kind of platform aspect of things a few times. Like within the industry, it's much more common for this to be segmented. So you have small development shops who are going out and finding deals, then they're selling them up to a larger developer, owner of assets, which is then hiring someone to engineer and someone else to build the projects. So by us bringing these things together, it's how we're finding a lot more like replicability of our projects, and a much better experience for the real estate owners that we work with as well. So just in terms of the overall platform and in terms of how it actually plays out, number one is, I mentioned earlier, we're dual headquartered in New York and Toronto. The regions that we focus on is, number one, the Northeast US, really anywhere from Maine down to about Virginia right now, with a real concentration in New York, New Jersey, and Maine's been a really good growing market for us. And then the Philippines is also a really good market for us. It's a much smaller market than our US market. Bit of a backstory that maybe I'll save for another day in terms of what got us there. But we've been there for about 5 years and are very well cemented there, and have a nice growing business over in that country as well. But so centrally across the company, we have our engineering and design group, and then also our capital group to be structuring the finance of these projects. And then in market, the way that we found it works best is we have our business development teams and our deployment teams. So one side is developing the projects, and then the other one is building those once they get to the point of construction. So in terms of our project structure, so now this is like a recurring revenue model, right? So when we're working with our clients, we're putting together what the deal will look like, and then we're structuring the finance around those as well. The projects themselves, whether they're in the US or the Philippines, and whether they're a situation where it's all going into the grid, or if it's going to the building owner themselves, it's all fundamentally the same. And what I mean by that is we're generating energy, we're selling the energy, collecting revenue for that. And so you can almost imagine the financial model that we build for each of these projects, and that's our top level revenue line. We then leverage those cash flows to fund the build out of the project, and then collect positive cash flows and a good return for the project, both upfront and over the course of the project. One point I'll highlight there is that because we're doing the full end-to-end, we engineer the project, we build the project, we develop the project. That's one of the ways that we actually are able to structure the financing and collect positive cash flows, even like as we turn on the system. So it's not a matter of us needing to fund our deals with equity, but rather through the structured finance aspect of our business. And within the industry, really our value add, the number one is, I'd say the most valuable thing in this industry is developing attractive projects. So we're in markets, developing ourselves these good deals. The end-to-end platform allows us to bring those projects all the way up to a de-risked operating asset. And then number three is the structured finance aspect of it as well. There's certainly some secret sauce in that part of it as well. So for the company and our history here briefly, I mentioned a couple times the turnaround word. What happened is, so as we were building out the business, we acquired an EPC, a company that engineers, procures, and constructs projects for other solar developers back in 2016. And it brought with it a lot of lower margin EPC revenue. And so you can actually see in the bottom chart here what we mean by that. So it's not too difficult in this industry to make decent, a good amount of revenue from EPC business, but it has quite low margins. So when we made that acquisition, I saw our revenue grow quite substantially, but we got to the point where we decided that we were kind of killing ourselves by trying to chase margin on these low margin deals, and that we really wanted to get back to who we were in terms of a developer bringing those projects all the way into operation. And I will say that in the public markets, and actually in the US, probably the two best comparables announced that they're merging last week. But virtually all of their revenue is of the EPC contract only. What you can see here is there's a very slim margin profile, and on the overall margin in this hypothetical project, it's about 18 cents. So that's 180,000 for this example project. So what we did is we've gotten to this point of all of our assets developing, building, and then in some way playing the role of financing. I give that caveat because about 1 in 5 of our projects right now, the clients are going to own them themselves. We've been going towards 100% of self-finance deals for the last year or so, but there is still some that our clients want to own and operate themselves, and that's fine. But when really the reason that drove us towards this model is you just see the value retention or the margin retention as you build these different projects together. So UGE today, the first 3 pieces of the margin, which add up to 46 cents or 460,000 in this example, is if you develop the project yourself, you engineer and build it, and then the client's going to own it. And there's quite a bit of additional margin if you structure the financing and own and operate those projects as well. So that's a kind of high-level overview of how the margins play out there. And in terms of how that rolls into the backlog, though, which is the last slide here. So this is our backlog table from our MD&A. Like I said, our Q2s will have the updated version next week. But right now there's about 49 projects in the backlog with a present value of about 72 million USD. You see down the left side there, some are UGE financed, or about 4 and 5 of them are, and a minority are client financed. A few words on this. There is quite a bit of data on this slide, and we go into some more detail in our MD&A. But the things to highlight, of course, the market. Most of our backlog is in the US. The stage. So every project in here is something that we have a binding commitment, and we feel relatively assured that the project is moving forward. But within that, we track the stages of how mature they are. So the first 3 are going through the business development cycle, in essence, getting approvals for permitting, grid connection, structural review, things like that. And then stages 4 and 5 are into deployment, into the deployment stage. So those are in the process of getting built. Our backlog has grown so much this year that, or especially in Q1, you see a heavy weighting towards 3.1. We'll see those be maturing towards deployment throughout the course of the year and beyond. A few other things. The count, of course, is the number of projects. Capacity is like within the solar sector, we talk about it in terms of megawatts or kilowatts. One thing I'll say here, there's 43 megawatts on there. If I just quickly flash back to the last slide, this was a hypothetical 1 megawatt project. And we see if we are developing, building, owning, and operating that project, we'd estimate here about 80 cents per watt for that project. I think we tend to be conservative on across the board. Some might be more 60 to 80 cents. But the point being is even at 60 cents, the 43 megawatts of capacity here, I think that comes out at 25 million USD or more in value we expect to retain from our backlog. The year zero revenue, year one revenue, what this is trying to say, and we actually update the terminology a little bit when we release our next results, not telling you anything inside there, but just the year zero revenue means our upfront revenue as we deploy a project. So if our client is funding the project themselves, they're going to pay us everything upfront. But also there's some incentives in some markets, and there's some other reasons why we get some upfront revenue from some of our projects. And then, oh, I accidentally moved that. But the year one revenue is the first year of recurring revenue. So you could expect, in this case, it comes out to 6.5 million USD over, most of that is over 25 years. So that's an indication of how much recurring revenue from the current book of business we're expecting to generate. So anyway, that's like a quick intro into the backlog there in terms of how that plays out. So that's a quick overview. I have contact information on here as well, but yeah, back to you, Paul. I think you're on mute, Paul.
I was worried that might happen. What I was saying is you've answered a bunch of my questions, and you've created a bunch of questions for me. Let's start with so the solar industry. We're obviously seeing a lot of trends going in the right direction, where the cost of solar panels and solar equipment is going down. Are you seeing any of the same trends in the way your guys are installing? Give us a better sense of what is driving the dynamics to grid parity, or whatever the terminology is nowadays.
Yeah, it's I think it's a mixture of things. The first one I'll say is economies of scale, and this isn't necessarily in any particular order, but the industry has grown so much over the years, and I don't actually have that metric off the top of my head, but if the industry has grown exponentially over that time period, and as a result, all the costs have come down significantly. That's been certainly a partial contributor to gains in the technology. So the solar panels being the most visible aspect of things just continue to get more and more efficient. So it was 5 years ago, I would say our average solar panel wattage that we were buying was probably in the range of 250 watts. Now it's 410 watts from the same size. So you're getting quite a bit more energy out of the same size, and that just goes back to economies of scale, but also makes installation cheaper. It makes racking cheaper. It makes everything else that goes with it cheaper as well. And then cost of capital has become quite a bit cheaper too to finance these projects. So I mentioned earlier leveraging the cash flows of these projects in order to fund the build out of them and what have you. Right now, we're now seeing sub 6% in terms of non-recourse project level debt at the level that we're at. We already see the opportunity to see that come down at least 100 basis points more as our scale increases, and hopefully more from there as well. So yeah, I mean, I think it's contributing factors there. I wouldn't say it's necessarily been driven by environmental concerns as much as you would expect that maybe it would have. There were a lot more incentives in this industry 5 to 10 years ago than there are now, although we're still happy to take them where they exist. And yeah, so it's, it's really a combined factor of all those things. But when it comes right down to it is, questions around intermittency and what have you are really questions of yesterday. I mean, in part because battery storage costs have come down, but more because people understand that, the grid itself is dynamic and has been dealing with shifting loads and what have you since it was built. And so solar playing an important part of that um, has been a lot, I think, more easy to solve than people were maybe talking about early on. And yet at the same time, battery storage has come down the cost curve so much too, that in some of our markets, we're starting to integrate battery storage more often too, simply because it makes the projects more valuable.
Excellent. So you guys you're going more towards building and owning a project yourself. Walk us through what that looks like. Everything from, I mean, what are you doing? You're driving down the street, you see a building, you say that's a perfect place to pop our solar systems up on. Walk us through the whole sort of chain of events until you guys got it up there and you're generating revenue.
Yeah. It originally started out with that. We still call it like two guys in a truck model, but yeah, no, and I think it's, nowadays, and I'll give a quick plug to Sophic Capital as well. I mean, they came out with a kind of a research report on UGE just last week, and I know that's available on their website. But right now in New York in particular, it's almost all referrals. It's real estate companies very rarely own just one building. It's much more a matter of owning 5, 10, 20, 50, or in some of the really big cases, hundreds or thousands of buildings. And so for us, it's identifying those relationships, starting to spin them up to a point where we're working through all of their buildings and future buildings for the clients that are growing and developing new projects. But no matter how we find the deals, it's, originally, we know our markets very well. Like, we're very, very hyper focused on where we're working. And so in those markets, identifying sites that are going to provide good economics, and speaking to the client of what we believe that we could provide, signing them into a letter of intent, committing them to move forward with it. But then, I think there's some secret sauce in it up to that point, but actually going from that point of commitment up until construction is probably where developers, including ourselves, really set themselves apart from others. So we need to work with the grid, whatever grid it is, depending on the market that we're in. So there's all sorts of considerations for what the cost is going to be to connect to the grid, what upgrades might be needed, how we might change the system design in order to avoid some of those upgrades and things like that. So we're working with the grid. Our in-house engineering team is going through the design. We're going through permitting considerations and things like that. We're, at this point in time on the financing side, we have partners that we work with, and so I think the process there isn't as complicated as it used to be, but we're lining up the financing to start buying equipment and building the project and so on. And then, so construction starts. Now I'll say that commitment to construction is, and then, sorry, I should say we're also, for a new client, negotiating the actual lease or contract that we're going to have with that client, which for a new client can take some back and forth as well. And so that process is probably 4 to 6 months. The grid in New York, for example, is required to come back to you within 3 months. So it's often, and they do, but it often means that you're taking 3 or 4 months to get that approval. And then, so the deployment is a similar type of time frame, but it's a little bit more at that point in time, having goods arrive, managing subcontractors, permitting and approvals from the utility as the system's turned on and things like that. And yeah, so you add those two things together, and that might be, say, a year, or if we're working on a larger portfolio, we might stage things out a little bit. Yeah, and then if you think about that year, and I mentioned the turnaround, kind of felt like we came out of the tunnel at the beginning of this year, we're just right now turning on our first self-financed projects. In Q3, we've already turned on some of our first ones that weren't yet turned on in Q2. So we're spinning this part of the business up quite quickly now. across the markets we're in.
So I'm trying to think of it, like this is sort of free money for a building owner or a landlord or an agency. Why would a company not want to have a system up on their building?
Yeah, I think that there was so one aspect of it is that this industry is really new. So this ability for us to, like, behind the scenes, what's happening is we're paying them free money for their rooftop. Say like selling the energy into the grid. What we're really doing is we're working with third parties we work with to line up purchasers of that energy that take it off the grid for them. And because the point I'm trying to say is, like, the ability for us to do that in New York is within about the last 3 years. Maine, which we've announced some deals in, is something that opened up this year. New Jersey has a pilot program right now where it's able to do that. So this aspect is growing really quickly right now, and that's partly why we see our backlog growing so quickly right now too. But there's also the very typical adoption curve. One of our clients that Sofek had talked to, that they mentioned in the report, we did one project with them at the end of 2017. It was the first community solar project in New York, and now literally every building that they buy or build, they're just letting us know the time frame, and we're working together to put solar on their rooftops, right alongside their plan there. But I think, like, what's happened is, there was a deal we announced earlier this year, maybe it was late last year. We announced one deal with a very similar type of client, and then I want to say in, like, I can't remember, late Q1, we announced 7 more with the same client. So things are moving a lot faster as people just get more used to the idea. But like if someone, let's say we put solar on the rooftop, we have a 25-year deal, and someone wants to tear down their building and build a high rise or something like that, they'll need to pay a termination fee. And so some people, need to think about that. I think in that scenario, they're probably doing it for some big money making reason anyway. And so paying a termination fee is probably okay. And we get paid out our NPV of the project at that point in time. But that's probably the most normal, pushback we get. And one other just quick one is, we're, like, in New York, we'll see how rents go over, post COVID here. But we're typically paying about $1 per square foot on a rooftop in New York. Now, if we were, in a small town in upstate New York, $1 or $2 per square foot might be something you'd pay for inside space. But in New York, in warehouses and so on, I want to say it's more like $20 per square foot. So there's a materiality aspect too, which is also that barrier is certainly coming down as it becomes more commonplace, and as we just continue to refine our processes and simple things like electronic documents to sign and less and less legal back and forth and so on.
Mm-hmm. Well, so that sort of opens up another question as far as how do you scale? Like, what would be your limitations to scaling? Is it capital? Is it manpower? Is it what do you see?
Yeah, I think for us, it's probably two-part answer. Number one is having good developers, the ones that originate the deals and bring them up to a point of up to the point of construction. So working through that process is really important. We have a really good group of developers, but in terms of hiring and adding resources, that's an area that we're looking to build out to continue that growth of the backlog. We have someone starting here pretty soon on that side of the house. There's that aspect. I think that anybody who's followed the story or looked at the stock chart, like on the capital side of things, especially through the turnaround, that was a big consideration for sure. Is that we really white knuckled it through the turnaround, and we're supported by insiders and so on to get through that turnaround. But things have been definitely shaped up for us nicely this year. We did a small private placement back in February, and then the warrants of that private placement have fully been taken down. I know we press released that I think it was Tuesday of this week, just a couple days ago. And yeah, so things have certainly been improving, and yeah, I think there's a lot more opportunity for us to grow. I mean, we're in the markets that we're in mostly based on where we started from. But yeah, I think like once we have once we have good projects, we have a very good deployment team. But I think that's quite scalable. Like that's a skill set that we can add onto fairly easily in terms of in-house or contract-based project managers to build out that function. And on the financing of the projects, that gets considerably easier as you get more projects. So on that side of the house, we're already benefiting from having more projects in our backlog to be talking to with our finance partners.
Is there I still vision this like a real estate project. Is there an equity component you have to put down, and then you go to the bank or you go to your funders, and they will finance a percentage? Maybe break down a little bit of that for us.
Yeah. So to a degree, I guess is how I'd answer that. The two ripples or what have you. Number one is, and this is a bit more a U.S. answer than a Philippines answer. That's where most of the backlog is anyway. So in the U.S., in addition to like our capital stack, in addition to debt, there are some tax credits, and those tax credits for a young growing developer like us and like other developers. They don't have the tax appetite to properly monetize those tax credits, and so you typically bring in a limited partner to take a minority stake in the project, but to monetize those tax credits. And so kind of going back to your question, so the debt now is maybe playing a 50 or 60% of the sort of the project value, and so there's already quite a bit of equity in it for them to get them comfortable with that. But then the other aspect that we've been, like, we haven't had any pushback in terms of, like within the UGE structure, we have business units within our company that are developing projects, building our projects, financing our projects, engineering our projects. I mean, that's pretty much like the four subsets. And so being the turnkey end-to-end platform that we are, we're in essence, like, taking margin off the table for the work that we're doing that a third party might otherwise do as well. So I mentioned on an earlier slide that when we're financing our own projects and turning those projects on, like it's a cash flow positive aspect to it. It's not a matter of us needing to write an equity check in order to do that.
So the standard project, considering all that sort of stuff, what kinds of payback period you're going to get on one of these projects?
So we really solve for like IRR and the cash flow of it. If I went to payback, it's kind of in like the varies by market, but 4 to 7 year type of range is what I would throw out there. But yeah, for us it's mostly a matter of collecting. We have a target sort of cash flow margin that we aim to collect as we build out the projects, and then we also have a target IRR over the project lifetime as well.
Okay. Are you able to tell us what that target IRR is?
Yeah, so the way it breaks down is, and it's I don't know this is the sort of the most intuitive, but it kind of like speaks to where we came from. But because we came from a point of like engineering, building projects for other developers, we had a target gross margin on that business of about 20%. And so when we're financing these projects, we're looking to capture that positive 20% cash flow on the execution of those projects as they're built. And then on top of that, on an unlevered basis, our target IRR is about 10 to 11% as a minimum threshold. On a levered basis, it certainly exceeds 20%.
Awesome. Perfect. So you'd mentioned that trailing 12 months you did 3.6 million in revenue, give or take. Is that all sort of that upfront tax credit pieces that you talked about, or is any of the recurring revenue? And then sort of going forward, what kind of mix can we expect to be, sort of lump sum and recurring revenue?
Yeah. So in terms of the 12-month look back, which would be up to Q1 of this year, because Q2's of course coming out Tuesday. So on that actually still had some of the EPC revenue in it. We had fully kind of wound down the business unit from an operating perspective by the end of 2019. So which meant that, like, I think in Q2 of last year, which would be the last quarter in those 4 quarters, there was still at least $500,000 in that quarter of EPC revenue. So most of the revenue then is one time. It is a mixture of, it's mostly driven actually by client financed in that look back. I mentioned earlier that our first self-financed projects we've been turning on this quarter, Q3. So not even in Q2. Although in our Q1s, and we'll speak to it in our Q2s, we go through the amount on our project, which is construction in progress and so on for those self-financed deals. So the recurring revenue will start will start ticking up in Q3 of this year. So when we come up with those numbers in October. And we'll start, yeah, we will break that out so you can start calculating the layers of that as that happens. I think you had asked a question there too, Paul, that what should expectations be going forward? I would probably just point to the backlog table again. You know, there's about 50 million in this table of the upfront revenue. I think I forgot to mention it, but the full backlog we aim to deploy within 24 months from when it was published. So that in itself gives quite a bit of upside to our past revenue numbers. You know, this is probably a natural question, so sorry to jump ahead on it, but like from COVID, from mid-March or early March through all of May, the deployment was shut down in the markets that we're in, almost in entirety. And so June, we were very much back active, and we've remained active since then. But just in terms of expectations on what timing that'll start hitting.
Gotcha. Okay, so we've mentioned the sort of $72 million backlog a couple of times. What kind of time frame do you expect that to be executed over?
Yeah, so we aim to have it all executed over 24 months. You know I went into, I threw a lot of information at the audience here in terms of when I had this backlog table up, but the 72 million, the aspect of it that's self-financed projects, the actual cash flow on these projects is closer to 200 million over the lifetime of the project. So the total value here is a project net present value. So I'd say that if we're thinking about the next 24 months and we're trying to calculate how's that 3.6 million trailing revenue going to grow, what we should be thinking is, number one is that 15 million of upfront revenue should be hitting over those next 24 months. And then the year one revenue, the recurring revenue, will start ticking up in that period of time as well. And so, you know, over the next 24 months, you know, just very back of the envelope, you're talking at least 20 million of revenue over the next couple of years. I think the question embedded in that though was like the timing of that. So the other thing to be looking at is just the timing. If a project is stage 4, stage 5, you know, that means that it's either in deployment now or is about to be in deployment. Whereas something that's stage 3.1, really that's a 2021 revenue at this point. That's not going to be revenue this year. And 3.2, 3.3, you know, might be somewhere in between.
Okay, so I got to be clear here. So the 72 million we're talking about, that's the capital costs, right? Is that what we're saying?
It's actually what we consider the project net present value.
A net present value. Okay.
Yeah.
Gotcha. Yeah, because then that sort of was going to lead me to my next question, because now we sort of have a better idea of what sort of revenues we can expect on an annualized basis if a project's 10 million but it spits off $1 million in revenue per year. Well, now we know we've got a better idea what the ongoing revenue looks like. So thanks for that. Perfect. Give us a sense of, let's just say on the recurring revenue component, what kind of margins you get on that? I got to imagine once your capital costs are sunk, it's got to be pretty good margins.
Yeah, and that speaks to the difference in our business mix over the last couple of years. So we've been averaging 27% over the last 5 quarters. That is more than double of what it had been when we had that EPC services business. So right now that's where it's at. I think there's room for that to grow, but that's a good placeholder to start with.
Gotcha. Okay, I've got just a couple more questions, and I know we've got a number of questions on the chat line. Just a reminder, anybody, if you got some questions you want to ask Nick, please enter them in the chat box there. Let's see. Okay, so you mentioned COVID, and I always like to ask this question now, but you did touch on the fact that you had some deployment issues or shutdowns because of you can't really move people around, and certainly New York being a big market, that was hit pretty hard with COVID. How are things now, and how does COVID change the landscape or the trends in the industry in your mind?
Yeah. So yeah, the most visible part of our business is, of course, deploying the projects, and like we talked about, that was slowed down and has picked up since then. And the winning of new deals. I mean, we had a record quarter in Q1, and actually most of that was in March. So like as COVID was starting to hit, and I think that we feel like that's continued since then. I'm not going to say to the same level, but definitely like the pickup in interest has. And I think, certainly part of what we attribute that to is that things are changing in terms of real estate, and people aren't paying and what have you. And so we definitely have felt an uptick in terms of clients that are that much more interested in receiving a rent payment for a roof that they're not otherwise using. So that's been helpful for our business. The types of businesses that we work with, like a good portion of it is related to distribution centers and last mile warehouses and all these types of things. A couple of our strongest clients in the New York market are in that business. And so we've all seen you've probably seen headlines of like Walmart and Target and so on's growth during this time, and so I think those are good clients for us as well. So I mean, I think going forward, we feel very good about the real estate clients that we work with, us providing something valuable to them, even more so during COVID.
Yeah, I'm going to open it up to some questions here. Dave asks, okay, you stated 40% of all new energy is solar. Give us a better idea of what that means.
Yeah. So, and that was in relation to the overall U.S. Energy market. And so in U.S., Canada, everywhere else, each year there's new energy supply coming online. At one point in time, that might have been coal or nuclear. Natural gas, of course, has been a big aspect of the energy mix in recent years, and renewable energy is more and more an aspect of this too. And so this goes to providing energy for more demand. It also provides energy for plants that are being decommissioned and what have you. And I don't have the number off the top of my head, but like it's a large amount of new energy is built each year, whether that be in the U.S. or elsewhere. And so, yeah, all this means though that all the new energy built in 2019, out of all of it, 40% of it was solar.
Oh, impressive. So you also mentioned cheaper than the grid. Does this include all the capex that's required for this type of power?
It does, yeah. So one thing I'll say is like the cost of the grid varies quite significantly depending on where you are. Quebec, I guess when Bitcoin was exploding, we all got some insight into this by people mentioning cheap energy in different places. But yeah, so but like number one, I guess I'll say is that we target markets where we know that we can provide cheaper energy than the grid. There's different aspects to that, but distributed energy being on site and in communities that are using the energy themselves, you save a lot on the distribution of that energy and so on. Speaking a little bit more of the overall market, not just commercial solar, but solar in general. If you follow if you see the right headlines in your newsfeed, the cheapest energy in the history of the cheapest energy being procured anywhere these days is coming from solar, and increasingly so solar plus battery storage. And there's been all sorts of headlines from um, all over India and Saudi Arabia and Chile and other places in the world too that are providing energy cheaper than power plants. So it's not just on the distributed energy side of things too. And natural follow-on question is like, do I expect this to continue with that solar continues to get cheaper? And the answer is absolutely. It's all online because of COVID, but the biggest China-based solar conference was last week. And earlier I talked about going from 250 watt panels to 410 watt panels. Now all the rage is like 500 and 600 watt panels, which are coming down the pike and what have you. So yeah, I mean, I think I have a stake in this game, obviously, but I look at this century that we're in. I don't have any doubt that solar is going to be the most important source of energy for humanity over this century, because it's just getting cheaper and cheaper and getting more and more usable, partly because of battery storage, but also partly just the overall value chains and so on to deploy it.
That's great. Now you guys operate in New York, New Jersey, the main area. Why there, and why is it growing so fast?
Yeah, so the answer to why here, and I'll answer the Philippines question at the same time because there's a bit of an overlap there. I'm from BC. I came to New York for my first job, and that's why we ended up founding the company here. Is because I was here, and this market happens to be the largest concentration of energy use in the country. For obvious reasons, just based on population here and what have you. There's obviously a huge infrastructure to supply that energy and to supply goods to the city and everything else. And so we found ourselves in a very good market by being here, and that naturally stretches across the river to New Jersey, with the two operating as one in so many cases. So this has really been sort of like our initial beachhead where we've grown the company and had initial success in. In earlier years of our company's history, I think probably maybe like any young company and what have you, we tried to be too many things to too many people, admittedly. But in that process, we did a lot of international work. The sector was a lot younger, but we had a partnership model where we were kind of doing what we do, designing and deploying systems, and working with partners in other markets. Someone who's followed the company for long enough would remember that we had like a nice go in Panama at one point in time. But the Philippines was one of the markets that we found ourselves having a lot of success in. It's very briefly, like, it has a nice Goldilocks formula. The solar resource is great. The cost of doing business there is low. Business is done in English. Getting leverage for our projects is plentiful. One of the really key ingredients, actually, the two key ingredients for us to be good in a market is having a UGE champion, someone who knows the company and is really good at understanding our business model and driving that forward. Number one, and then number two is having a local champion, someone who knows the community, knows that market and what have you. And in this process, this was about 5 years ago now, the number one most popular sport in the Philippines is basketball. The Michael Jordan of the Philippines is called Ramon Fernandez, or El Presidente is his nickname. He's been retired now for maybe 15 years, but still a very well-known celebrity in the country, and really wanted to work in sustainability. And so Tyler, a guy from our team, moved over there, and we it's 100% UGE entity, but him and Ramon kind of co-founded UGE Philippines back about 5 years ago. So it's provided a really nice model for us. We're not going to try to be everywhere at once, but it's provided a really nice model for us to hopefully leverage down the road. But Tyler's from Maine. Tyler is, he saw an opportunity. The Maine market was just about to open up. He decided to repatriate back to the U.S. and we got in right at the ground floor. And Maine had a Republican governor that had very restrictive policies against renewable energy. Tyler saw an opening, moved back there, and we've a good portion of our U.S. backlogs now in that market, and it's very fertile ground, and that the market was like the country, the state story around it, Massachusetts, Rhode Island, Vermont, a little bit less so New Hampshire, but to a degree, have all really robust solar markets. Maine, we got in at the right place at the right time, and that's been a good one for us too. But the last comment on this is that, broadly speaking, solar makes good economic sense in more and more places, and so we'd love to fill in more of those states over time as well.
Mm-hmm. Gotcha. Quickly, let's talk a little bit about the stock. I think we said roughly 25.7 million shares outstanding. You had some warrants exercised recently, so I think that number may have gone up a tiny bit, if I'm not mistaken, up to around 27 million. What price and when was the last financing you guys did?
Yeah, so we did a small financing at 26 cents back in February, and that's really the only financing we had done since 2017.
Okay, and you said roughly 50% are owned by insiders. How much do you own? What percentage do you own?
Yeah, so I forget the exact percentage, to be honest. I want to say it's mid to high single-digit % is the range it's in.
Okay, so you got a good vested interest. You obviously want to see this work. That's a good sign. Good. Maybe back to a few other questions. Okay, this is a stock question. I've got one that says, Devin tried to buy UGE-TSX through Ameritrade 2 weeks ago in the US, was told it's not trading. Do you know anything about that? Do you have a viable US symbol?
I do. Yeah,
okay.
I work at, Stofik and I, the team there and us were discussing this recently. For some reason, TD Ameritrade in the US, you can't buy UGE-TSX. You could buy UGE through E-Trade and Schwab and Fidelity and everything else, but for some reason, TD Ameritrade, there's some sort of hiccup. And in Canada, actually, some aspects of TD in Canada, you need to call in the trade. So we talked to the exchange, and they've said they've heard of this happening with other venture companies. But when we've actually spoken to TD, what they've told us is not much. They haven't told us much. So if anybody has any ideas on that, please let me know. But it's been frustrating for sure.
Okay. Quick one. I know you referenced this, and I should have took my notes, but EPC. You mentioned EPC. What does that stand for?
Engineer, procure, construct. So it's very much a solar market term, but that's the type of business that is, just building projects for other solar developers.
Mm-hmm. Gotcha. And then you mentioned structured finance a few times. Who typically do you get debt from?
So typically in the US, we're working with a group called Wonder Capital, which is a specialized debt funder of solar projects. There's a lot of appetite out there, though, to provide debt into these projects. So probably in any given quarter, we're receiving one or two other term sheets from other lenders. So we might, yeah.
Okay, and you mentioned 6%. So compared to a lot of the other money, that's the kind of interest rates that investors are getting, that's pretty healthy return. So I can understand the demand. Nick, can you expand on value in the example you used on the $72 million backlog? Jeff says it equates to 25 million in value at 60 cents per kilowatt. What does value mean?
Yeah, so and I think that 25 million, I know I spoke to it. It's really kind of some quick mental math combining the backlog table and the value retention slide there. But in essence, I'll say how we speak to this internally in terms of management is on any given project, we can extract value. It's almost like two bookends, right? We can take value out up front, or we can leave value in the project. And so it's really a summation of those two things. As a young growing company, we look to extract some value up front in terms of funding operations of the business and what have you. But then we also look to leave as much as we can in the projects in order to develop up, to continue to build our balance sheet over time of these long-time recurring revenue. So there's a trade-off between those two things that in any given circumstance, in any given circumstance, we're going to play off one or the other. But in this hypothetical example right here, you see that for a project that we're developing, building, financing, owning, and operating, this is based on a specific New York project. We see 81 cents of value there. So you can kind of plug that into the total backlog to get a sense of what the value would be over time.
Mm-hmm. Okay, good. So let's hypothetically, it's not even that hypothetical. You get $72 million backlog. Some of that is not UGE owned. The stuff that you guys own, you must have a really good idea of what that revenue is going to look like over the course of the next 5, 10, 15 years. Can you give us an idea what that looks like?
Yeah, for sure. No, and we do. In many cases, it's locked in for a good portion, if not all of the project lifetime. I know I have the backlog chart up here right now, but let's say that magically all of these projects were turned on tomorrow. The 12 months that would follow, we'd expect to get 6.5 million of recurring revenue from that book of business.
Perfect.
And over the lifetime, like these projects do have some level of inflation adjustment over time as well. So you'd expect those numbers to grow a bit.
Right. And a reminder, that's US dollars we're talking about, right?
That's right.
Perfect. Okay, I'll take a couple more questions and we'll wrap up because I think we're going a little bit long on time here. We've got a question to ask you about your insider share lockup.
Yeah. Through the turnaround. I mean, I think that we weren't trading all that well, and someone had suggested to us, hey, why don't insiders are all locked into this for the long term. Why don't we make that official? And so myself and the two other largest shareholders, we all signed I think 3-year lockups saying 100% of the shares, we wouldn't sell any shares during that time period. And I know insiders have bought some shares since then as well. So that's what that's about. I guess that must mean I don't actually fully remember when it was put in place, a year and a half ago. That would mean there's 1.5 to 2 years longer in it. But none of us are thinking about that.
Okay, good to know. And then this last question, more around geography. Obviously, it's a lot sunnier in Nevada and California, places like that. Why aren't you guys there? And is the economics, why New York and why not California?
Yeah, the California has been a good market over the years. In our days where we were a little bit less focused, we actually did some cool projects in California. We did the Dropbox headquarters. Any fans of the Cheesecake Factory? We did their headquarters. But then we really got focused around where we were based. And earlier I talked about the potential size just of the New York market, and I think it leads to understanding why it pays to be hyper focused. California is a good market. Nevada is a pretty good market. The one thing I'll say is the sunshine is an important aspect of it, but it's not the only aspect. If you can see out my window there a bit, it's pretty sunny here today. But even more so, the electricity costs are very high. The electricity prices in New York are, New York and suburban urban areas in California are kind of the two highest in the continental U.S. And so high energy prices mean that we can beat those energy prices that much easier. So there's that aspect to it as well.
Gotcha. Nick, on that note, I want to, we'll wrap up a little bit here. What we always like to do is give you guys an opportunity to leave the audience with any key message, or ideally, what the average investor should look for over the sort of the next 3 to 6 months. Why don't you let us know what everybody can expect?
Yeah, no, and thank you so much again for the time and the opportunity here today. Over the next couple quarters, the really big thing for us is seeing the business model evolve. I've mentioned a few times, like I speak to it as though it's we've been self-financing projects for a long time, but it's been kind of the evolution of everything that we've known over the company's history to a point of putting it all into practice over the last couple of quarters here. And so over the coming quarters, I expect that we'll start to see more and more of those projects, reach the commercial operation point on our balance sheet, and we'll start seeing how that plays out in terms of our income statement and our balance sheet as that happens. So I think, from the conversations I have, I think we've certainly sparked a good amount of interest, but I think that the interest is just going to hopefully continue to grow as people see that business model come into effect. So we're very focused on execution of the business model. The very large backlog, we're very, very busy putting that onto roofs and onto the ground where that's the case. And we'll just make sure that we keep everyone updated on how that goes. And then the shameless plug again, our website /register for our webinar, which is on Tuesday for our Q2 results, and future results will be there as well. And then also on our website, our investors page, there's more information there, and you can sign up for our newsletter that we send out for key announcements as well.
Perfect. Sorry, now I didn't catch it. Did you give the website address?
Yeah, so the website is UGEI.com, and then to register for the webinar is just /register.
Okay, perfect. And if somebody wants to contact you directly, what's the best way they can contact you?
Yeah, I'll just flip to that page here again. So, my email there, just first name dot last name at UGI.com. My office line's there as well, and then also Sofix information is on there as well.
Fantastic. Nick, I want to thank you. So reminder, UGE, roughly 25 million shares outstanding, market cap about, call it $10–11 million, 72 million US in backlog, and insiders own a really big piece of the company. So keep that in mind. Nick, I want to thank you again. I'm sure we will catch up in the near future as well, but I want to thank you for giving us a good idea of what you guys are up to. Good luck. We'll look forward to the quarterly numbers next week. And, thank you again.
Yeah, sounds good. Thanks so much, Paul. Thanks, everyone.
Awesome. Trevor, over to you.
Yeah, thanks again, Nick, for joining us on the Small Cap Discoveries conference call. And as Paul mentioned, we look forward to the financials next week and speaking with you again.
All right, thanks again. Take care.